Hi, this is Paul Carlson, CPA with law firm Velocity. We get lots of questions about the tax deductions for written off client invoices. So on the screen I have a couple different examples we're going to walk through to kind of explain what people think is happening and then how things actually work under US tax law. So the first scenario is accrual basis. This is giant corporation accounting. And under accrual basis, when we send the invoice to the client in 2018, even though they haven't paid it, we record the $3,000 revenue based on that invoice amount. That we've done the work. Accrual basis accounting says we report revenue when the work is done. So work is done, invoice went out the door. So we're going to show $3,000 of revenue on the income statement. 2019, we realize a couple months later, this client's not going to pay. We're never going to get their receivable back. So we book a bad debt expense, which takes the receivable off the balance sheet, and we pick up the expense. Note that the total revenue from this client between the 2 years is zero, that the two numbers offset. In full accrual accounting, there would have been some sort of allowance for bad debts accrued in 2018. We're going to ignore that for the simple example. So here's the confusion. U.S. law firms pay taxes on cash basis, that we don't pay taxes based on accrual basis revenue. Our friends in Canada do pay taxes on accrual basis, so in Canada this is what their financials would look like. United States law firms pay taxes on cash basis, and what that means is revenue is not reported until the client pays the bill. So in 2018, we mailed the bill to the client for $3,000. The client didn't pay it. And so because we never received cash for the invoice, there's no revenue reported on the financial statements, and that revenue is not taxed on the 2018 tax return. In parallel, in 2019, when we realize we will never collect this and the firm writes off the invoice, there's no additional revenue deduction because the revenue was never taxed. That we can't pick up a $3,000 deduction when there was no $3,000 revenue reported in the prior year. And so under cash basis accounting, there's no real additional deduction per se for a written off client invoice. That these are all informational pieces that flow through the firm accounts receivable reports, and we really don't see this invoice write off on the firm income statement. Do note that even though there's no deduction for the written off invoice, that the firm did expense and deduct overhead costs, so rent and payroll, as those items were paid. So the firm did get the deductions for the costs that went into providing the service. So in working with hourly based law firms, we kind of see three pieces that are important to avoiding client write-offs in the future. So one is to have a strong marketing funnel, that if the firm is getting a steady lead of good clients, the firm doesn't take on questionable clients that aren't going to pay. Second is start to increase retainers, that as our firms grow and they get busier and busier, that they have less time for clients that they're not sure if they're going to pay. And the simplest process with that is to increase the initial retainer request. Some of this is a signal that if a client is required to pay a larger retainer, that the clients with no funds will kind of raise their hands and self-identify and say, hey, we really don't have any money for this, and they will kind of opt themselves out. And then the third is to monitor client balances weekly. And when client balances get too low, we request additional funds. And if additional funds don't appear, we stop work within ethics rules. So what I term a client balance is we take the amount of money that's in the IOLTA account, subtract out the client's accounts receivable balance, we subtract out their amount of their unbilled time, and we subtract out the amount of their unbilled costs. So what we're doing is we're weekly watching client balances. And what this does is it allows us to avoid the scenario where it's the end of the month, we're running bills, and we send a client a bill for $5,000, and we realize we had $12 of trust money, that suddenly we have a $5,000 accounts receivable balance that we have to collect, and we have no money to offset it. All right, thanks. Bye-bye.